On behalf of the entire Notre Dame community, we'd like to welcome you to our discussion today and thank you for being here and your continued support of Notre Dame. My name is Erin Bellissimo, and I'm the Managing Director for the Institute for Global Invested. I'm delighted to be here with this incredible group of investors and Notre Dame leaders. So what we'd like to do today is to really leverage the group that we have to talk about Notre Dame's financial position, the current market environment, get into some investing questions since we have such a great panel here, and also talk about some opportunities for our audience to leverage the endowment to create win-win situations for the Notre Dame family. So I thought we would just start with Notre Dame. And Jack, maybe a good place for you to start, just to give a sense of the university priorities, where you see our position today versus when you got involved with Notre Dame, and what should we expect going forward?
Sure, great, thanks Erin, and it's a pleasure to be with you guys, and thank you all for coming out. As you can tell, our primary mantra was let's have some fun up here, and Erin started it out well. Let me talk about just a couple of things around Notre Dame's situation today and priorities. It was 14 years ago, Father John gave his inaugural speech and talked about priorities, really a strategic plan, and it was around unsurpassed undergraduate education, enhanced graduate programs, and research as two of the core elements. We're all only here to serve our students and to serve society. And those priorities that we have, and all of this to be founded upon and wrapped within our Catholic values. Critical part of Father John's charge to all of us who are at the university and love the university. And that has been a strategic framework that this university has followed remarkably well over the subsequent 14 years, and those remain the key priorities for us. Continue to invest to be the best possible undergraduate institution we can be. And similarly, continue to expand our research capabilities, our graduate programs, our research funding from outside. And interestingly, early on, some people thought those were conflicting. Oh, we'll take away from the undergraduates to do the second part of this, but they're very complementary. The best students are attracted to the best faculty who are attracted to the best students. So those remain our priorities, and funding those are the priorities, frankly. This institution's in great financial shape. Yeah. It's in great financial shape partly because of what Scott and his team do, because of the benefaction from people. But Father John has an expression he doesn't use as much as he should. We should have a flag up there that says, excellence is expensive. And excellence in education is particularly expensive. So, we look and we say we need to continue to invest. We need to make colleges affordability for every single person who wants to come to Notre Dame. So financial aid is our number one priority, Erin, in terms of as we think about the go forward and how we build this place. Undergraduate, graduate, endowed, really critically important for us. And so we think about that a lot. We think about unrestricted giving, frankly. Yep. And you go back to one other great quote, which is Father Ted's, which is the greatest universities in this country will be the ones with the biggest endowments. And this is why, what happens in our investment office, the kind of things we'll talk about today, is so important to us as well. But if you think about, somebody says, what are the major priorities for this university? Undergraduate, unsurpassed in our way of doing it. Graduate, continuing to improve. Research, continuing to improve. That's how we think about who we are today, where we were, and where we'll go to the future.
And I think that's a great segue for you, Scott, to talk about in the context of how you manage the endowment, how you think about that, how does that impact or help your investing strategy, our time frame, and maybe then just talk a little bit about where you think the endowment stands today.
Yeah. Well, the way it helps us is it gives us an incredible brand that I can sell all over the world. I've never had trouble getting in to see anybody, whether it's in the United States or any geography. As you know, we're about 35% international, and we have great partners in countries all over the world, and they all know who Notre Dame is. So with our academic ascent and the things that we've done over the last 30 years, today for me it's even easier to find people who know Notre Dame. And so even in Asia, where maybe early on in my tenure, not as many people were aware of sort of a Catholic university, but now they are. So the academic excellence and the quality, and our alumni and what they've done, and our students, and they're now dispersing more internationally. That's had a huge impact for me in terms of being able to sell the university as a great long-term partner. If we're about anything, it's long-term and consistency and stability.
Yeah.
And that has played very well in the asset management industry for the last 30 years.
Aaron, can I interject something in
Sure.
that? Because one of the things that's so important to any university, but is core to the way the leadership team here, and I hope the board of trustees, it's that long-term point. You know, I think it's easier to manage the endowment here. Not easier in the sense, but it's easier in the sense that we truly think long-term.
Yeah.
We have an annual budget, but we're thinking about 5 and 10 and 30-year priorities. You know, we have a campus plan that goes out past most of when we'll be dead. But the ability to manage money the way Scott does for a perpetual institution that thinks of itself that way is very different. You know, there's a story in the paper, Harvard did something last year in its endowment. Who cares?
Yeah.
It's irrelevant.
And John, maybe you can talk about that as an investor in running your own investment firm and, you know, being in the private equity markets, what that means from the kind of clients you would like and why that's so important for everyone in this room to understand as they think about their own investments. And access to great products is hard to get. And adverse selection often happens. If Goldman's selling it to you or whomever is selling it to you, you want to make sure that it's a great, you know, investment product with high potential. So,
yeah, and there are a lot of experts on this topic in the room, and we're lucky to have them. I'd say a couple things. One is, and it's one of my favorite stats, but if you are in your 60s and you are married, the odds that at least one of you is going to live till 90 is, in fact, 90%. So we're all living longer. Of course, we all want to live better and more fuller lives. And then when you think about the average American, they think they need $500,000 to retire on, and the average American has $125,000. Furthermore, a lot of them are dependent on pensions, and if you look at the largest, the top 100 state pension funds out there, only 8 of them are funded more than 90% of their expected liabilities. So most of these are unfunded pension plans. And they invest about half of what they have in public equities, and by and large, people expect a 7% annualized return from public equities. Some years better, some years not so good. But they need to at least average 8%, in many cases more, to have any hope of making a dent in that unfunded situation. And universities like Scott have driven a really move more towards focusing in on alternatives. Why? Because alternatives, particularly, and this is the hard part, but finding those top quartile managers are going to deliver a return that's closer to 20%. And the question is, how much do you want to allocate to that asset class, or how much do you need to allocate to that asset class to hope, again, to put a dent in that state pension gap? Because, of course, you're not just going to put in all equities, you'll put it all in fixed income. And if then you flip over to what Scott's been able to do, realizing that he needs to maintain liquidity, he can only take so much market risk, but tilting the portfolio to the broad class of alternatives, the returns that are, the last 20 years over 12%, and if you were to look at that return relative to any other portfolio, it just dwarfs. And we'll get into this a little bit later, but all of you have that opportunity in the room to invest behind Scott and the team. And if you look at what kind of returns Goldman Sachs, JP Morgan, anybody who are great firms, Vanguard, they're not going to touch the kinds of returns that we've seen out of our investment office, not just for 20 years, 5, 10, 15, or 20. But the reason why all we alternative asset managers are in business is because of this funding gap and the need to have a payout that's closer to 8% in a world where those kinds of returns are really hard to find.
moving on to the market, I think that's a good place to check in with you, Scott, around, we've had a prolonged bull market, low interest rates. What risks do you see on the horizon, and what are you worried about? And then how does that affect how you've positioned the endowment, if at all?
Well, we worry about everything. That's why we stay really diversified. That's why we hire the best people to partner with and develop these long-term relationships. I've been through 4 or 5 cycles now. We've seen the movie, everyone's a little different, but at some point there's excess, you have a recession, and then you can buy your good assets cheaper, and we've done particularly well in those environments. But I'm worried about a lot of things. There's tremendous geopolitical risk. Nobody's been through the amount of central bank stimulation and quantitative easing that we've seen by the major central banks of the world over the last 10 years. It's unprecedented. We have no idea how that ultimately unwind. It's odd when the safest place to invest has the highest interest rates of the developed world. That seems very odd to me. You have negative rates in Europe and Japan, positive rates here, but yeah, we'd be the most attractive market, so why should we pay more on our debt, you know? So there's just a lot of distortions, and there's a very high probability of policy misstep, short-termism, there's a lot of things, political influence around, I'm not just talking about the United States, but everywhere.
Yeah.
So there's a lot of chances for mistakes. Those are the things I worry about the most.
Yep. And how do you, when you go into some of these emerging markets, especially when you were early in China, how do you go into them in a way that you don't, you're not the pansy at the table, or you don't get burned, and how do you partner?
Well, that's a very good question. That's a good example, because I went to China 6 months after Tiananmen Square, and then we didn't. That was early 1990, and we didn't invest in China until about 2004 or 5.
Yeah.
So it took a long time to get comfortable and to find the right partners, and then we found some great people.
Yeah.
And there are great people, great ethical, smart people everywhere, and we found some great people to work with. And then we went all in on them, and we've done like 22% a year in China.
Yeah,
for that
it's
time
amazing.
period. So it's a good example, though, how we try to do very deep research. Our team spends a lot of time there. You have to be there in those kind of markets and develop that network, and we've done that. And I'm very proud of our work there, because first of all, it's paid off for Notre Dame, but it was slogging through years of talking to people, getting to understand all of the nuances of the culture and the kind of people we can work with there. And now they're the second biggest economy in the world. There's some great companies being built. Our venture capital portfolio in China is fantastic. And so it's really, for the future, going to pay huge dividends for Notre Dame.
That's great. I have to ask, especially with Jack here, active versus passive investing. It's been debated, but nobody can argue the role that index funds and ETFs have had in the market over the last decade, especially. I think I read in August, this past August, that US-based equity mutual funds and ETFs topped those of active stock funds for the first time. It was like 4.27 trillion versus 4.246. What does that mean in terms of not having funds flowing with active managers behind that? Is that a good thing?
I happen to think it's a good thing, because one of the huge advantages Scott and his terrific team have is they find great partners. And there just aren't that many great investors out there. So most people should want to buy the market and buy it as inexpensively as possible. And that's, some of what the growth is just trend following, right? It's in the paper enough, I got to get some of that.
Yeah.
But
a market correction, does that change the psychology?
No, because what's happened is people understand that high-cost bad active is a really bad place to invest.
Yeah.
And it should die, and it should have died 50 years ago, and it's dying a death today. They're not going to go back. They're not going to say, I suddenly want high-cost bad active. But it's also not going to dominate the world. Like people say, if you follow the lines, eventually everything's indexed, which is not possible, actually. And there's plenty of liquidity in markets, and there's plenty of liquidity to create fair valuations. If you had 99% of the market indexed, that'd be a bad thing. If you had 70%, it's probably a good thing. There's another part of it that's good as well. An index fund is a permanent holder of a company stock. They're a better owner than somebody passing through for a week or two. And I actually believe that companies would be better run with many more permanent holders. John buys companies, right? He buys companies. And if you're a CEO and you had 60 or 70% of your stock owned by long-term indexed investors, you go talk to them about strategy, not about the quarter. So I think there's a whole bunch of benefits from this. I think a part of it is I'm following the winners, but people just aren't going to go back. The other one last point, and this is something that Scott does, his team does so well. If you're going to pay fees, pay for somebody to take risk. right? And so you're not going to have 100 beta and 100 R squared, 99 R squared funds or institutional portfolios get any money any longer. It's going to be the highly concentrated, high risk, high reward portfolios where you go pay me 2 basis points.
Right, and I was going to ask you, Scott, so yes, the Notre Dame endowment broadly is diversified, but when you're looking at managers, are you looking at more specialization than you used to, whether it be geography, asset class, industry, what?
Yes, for sure. And that's definitely evolved over the years. Much more nichier investments, in all asset classes, all over the world. Just to add to Jack's point, there's really only maybe 50 or 60 really good institutional investors who can build out a team and do the research that we do and earn superior returns. There's not that many. Most everybody else should be having some sort of passive, at least some portion of their portfolio, and then maybe some active strategies around it. But I've looked at thousands of people's investment funds over the years, and from the Notre Dame family, and literally most of them I wouldn't touch. It's very high fee, crappy alternatives that the banks sold everybody over the years, and we wouldn't touch any of that. Yeah. So what we do is actually hard. It's hard to do unless you have the advantages we have: long time horizon, a great board, a great staff. I can hire the right people. I can get access to anybody. Those are great. Permanent capital. We raise money. We have money. It's always going to be there. So,
but
that's unusual.
The other thing you have is a great reputation as an investment office. So if I have scarce capacity, I'm not trying to shine his shoes. They're already shiny. But if I have scarce capacity, my oldest runs 2 funds that have no more than 12 stocks in them. They've done fantastically well, but he will only let somebody who's of the caliber of the Notre Dame Investment Office be a client. He'd rather have no money than bad money.
Right.
And as you said at the beginning,
we take advantage of that.
You make a call and somebody knows, and if they reference check the Notre Dame Investment Office, it's an impeccable reputation.
When I'm trying to sell Notre Dame to potential firms, and we talk about, now how do I know you're going to stay with me through tough times? And I said, let me tell you something. We've had 3 presidents since 1952. We've had now 3 chairs of the investment committee, just as 2 months ago, since 1978.
Don't forget, he's still on Harris's still on probation, so we may be back to 2
I'm
before
31
you know
years. 3 of my directors are 20 years plus. The other 2 are 15 years, to Jack's point. So then they get that. They're not going to be dealing with a lot of different people over time, the same people. And that has been huge, absolutely huge for us.
But one of the other reasons they're here is for the mission. They're as committed to educating students as they are to generating investment returns. And, having seen train wrecks in our competitive institutions over time, it's short-termism from a career standpoint, it's short-termism from a strategy standpoint. And, the only one that's a peer of Scott's is David Swenson at Yale. Yeah. And he's been there 30 years, right?
Yeah.
His team turned
33 or
some,
4.
but there's a lot to be said for continuity and a deep commitment to the mission of the institution. And my first time I met these people, I made the mistake of saying, "Now, where did you go to college? Where did you go to college?" At number 7, she looked at me and, "What kind of idiot are you?"
Somehow I squeaked in. I don't know.
They're all donors. They're all donors, and they choose to come back to serve the mission of this university. It's worth 50 basis points a year.
Somebody told me once, you'll never be as good as Yale and Harvard and them unless you move to Chicago, because you'll never get the talent. So I came back and I did a poll of my team. How many want to move to Chicago? Nobody. And that was 15 years ago or so.
You've done okay.
So that's done fine.
Yeah.
Yeah, and I'll just do a shameless plug for the Institute of Global Investing. All those active managers that are going to be turned out, the very small slice that are good, they're going to be trained here. So, the culture of the investment office partnering with us and our students is a huge benefit to us from a curriculum perspective, and having the practitioners and having sat on the other side of the table from Scott as a marketing person. When I came out to Notre Dame, a lot of heads of marketing at firms called me and said, "Can you get me in there? Can I get a meeting with Scott?" And they're great investors, but they're not the elite, and that's a credit to you and your team. So, well done. So if you have the opportunity to invest with the endowment, which I'm sure John's going to get to during this, you should take it. Let's just kind of talk about interest rates a little bit, in the market. And, we've all been waiting for the rise in interest rates. And, especially as a private equity guy down there, John, maybe you can start us off with just like, does that change the nature?
I remember you were asking about what worries you, but I can remember distinctly in the May of 2007, I was at a dinner and someone said, aren't you worried, I was at JP Morgan at the time, about all this underwriting leverage and credit you have at the moment, given what's going on with the Bear Stearns real estate funds? I'm like, real estate, Bear Stearns, what are you talking about? And then by July, the credit market seized up. But meanwhile, the equity market peaked in December of 07, and you really didn't see any weakness until spring of 2008. And I think if you painted a picture of, as you talk about negative interest rates in many places of the world, so where are we going to go next if we do have recession? Iran bombing Saudi Arabia, Trump and impeachment, and Xi dealing with a pretty explosive situation in Hong Kong. And you'd be really, if I told you all that 2 years ago, you'd say, well, the market would be on its back and it's at an all-time high. And I think this drug that we've created with these low interest rates, and these governments around the world now don't understand it. They're like, why aren't our interest rates lower? Why aren't they negative? Let's go. It's a race to the bottom. And God help us when a recession hits, because there's nothing left in that playbook. The governments are not going to be in a position to bail out industry and commerce like they were in 2008. And so I worry about that a lot. And we all, professional investors, were worried about inflation, rightfully so, because you saw wage inflation, you saw freight inflation here in the United States, all kinds of signs of inflation. And that's all gone now. There's no inflation trade. And so I'm not sure.
No inflation and 3.5% unemployment.
3.5%.
What are the odds of that?
That's very unusual.
And,
Yeah.
if you look at the rate of inflation in this country, which is at the moment higher than our interest rates, even though there isn't much inflation, that's a pretty scary thing. So I think all of us are starting to wonder if the party's over and no one told us, like it was in 2007, and not many people figured it out. So I don't know. I'm sure Scott Danke, Tom Harris, others that are in this industry as well, Ward up there in the real estate industry. I know that as we think about 2020, we start to think about recession planning and what costs do we need, what are fixed, what are variable, how much cash do we have, how much liquidity. Another big warning sign last time was banks getting weaker. I mean, you look at Deutsche Bank, you look at some of the European banks really looking for bailouts. They're not trying to be negative, I'm just trying to be...
You're doing a good job of it.
I mean, don't believe anything I say. Go buy more equities and they'll probably go up tomorrow. But man, there's a lot out there that if a year from now we're in another global financial crisis, you go, yeah, we should have known about that. Well, it's all sort of staring us in the eyes. Now, there's plenty of reasons to be positive. We can get a trade deal. I think that'd be great. And the fundamentals of the U.S. economy are still strong. But I don't know. Who isn't nervous right now? I think we all should be nervous.
John and Scott, or Jack and Scott, what about in terms of fixed income as the portfolio then, and how do you, just
Well, we don't do a lot of fixed income.
as an individual investor, what should this group be thinking about?
It's a tough place to be, frankly. It depends
Yeah.
on time frame. As John said, one of the things he said, most of the people in this audience have a 20 or 30 or much longer time frame, and you ask yourself, are you willing to withstand volatility? And my own view is, if you are, old bets on 60-40 or 50-50 or the percentage in fixed income of your age just don't make any sense in this environment when you can get far higher yield on top quality equities, diversify them, and be more than willing to, if you're willing to not react.
Yeah, if you can control yourself. I mean, we have our students doing a lot more in the behavioral finance arena, and just, I think I read, even when I was at Columbia, the average retail investor does 600 basis points below the fund they're invested in just because of bad timing. They buy it high when they hear about it at the party, and they sell it when it disappoints, but if they had just done nothing,
There's staggering differences even if you got out of the market for a month, and so on and so forth, and that's why people have to have patience and perspective. But if you do, I think one of the things that's happened since 2008, listen, they did a fantastic job in the crisis to really save the financial system in many ways, but then they overplayed their hand. And the people who bore the brunt of that were fixed income investors,
Yeah.
the elderly, the retirees, and it hasn't gotten any better in 10 years. You know, how many times have we sat in investment meetings and said, well, rates are going to rise? We're now past a decade, and at some point, people aren't going to believe us. So I, for one, think fixed
No,
income.
I agree. They've looked very expensive to me for a while. But
Yeah. Can you talk, Scott, a little bit about maybe common mistakes that investors make and how you avoid those funds, or also just give some insight as, our audience makes investment decisions?
Well, certainly not having the proper time horizon commensurate with your liability. That's a huge mistake. And obviously, we've taken advantage of that because we do have such a long time horizon, and our board has supported that. And that's our culture, is to think that way. But I'm on the Vanguard board, so I see a lot of those kind of flows, and we're already seeing flows out of equities, and we're into fixed income, and maybe some of that's good because maybe they're rebalancing. I mean, some of that could be okay, but people tend to trade too much,
Yeah.
and churn too much. They generally don't know what they're really paying, the cost side.
Yeah.
I'll ask people all the time. They say, "Well, you look at my portfolio, and the first thing I'll say is, how much are you paying this person?" And they usually don't know.
Yeah.
And not to mention the underlying fees.
And
And
the
things.
reporting is designed so that
doesn't
they
tell
don't
you.
know.
It doesn't tell you, and I've yet to see a performance report from a bank. They tell you your values and list of transactions, but I don't really see real performance. So it's all of that for sure. Heavy trading, short term,
Yeah.
high cost. Those would be, I think, the biggest things.
Yeah.
And maybe not being tax aware, which relates to the trading
Yeah.
and all that.
Aaron,
So-
one of the things that's changed in the last 5 to 10 years, much for the better, is the ability to get advice at a very fair price.
Yeah.
And it's a trend that's bad for the sellers of advice and great for the buyers of advice.
Yeah.
And so one of the mistakes people think is they can do it themselves.
Yeah.
So they work for 40 years, put money in a 401k plan every 2 weeks, wake up and they've got $4 million, but they've never been an investor.
Yeah.
And they get handed the $4 million. They don't have a pension plan. And they think, well, that was easy. And, for 25 basis points, you can get a advice program that will help you miss all these mistakes Scott just made.
Yeah,
and I think it's one of the things that people are too little aware of today, at how the total cost of ownership has come down to have a professional help you. And I think when we look back in 15 years, it's going to be one of the things that makes the baby boom generation, me, be more successful in retirement than it would have been. People should always think about that. You can do it yourself, but the old joke is fastest way to make a small fortune.
Start with a large one.
And manage yourself, right? And that's one of the things I think people should be thinking very hard about as they move through a life cycle for themselves.
We're going to open it up to questions in a few minutes, but before we do that, I wanted, John, just maybe you could talk a little bit about Love the Notre Dame and what that means in the context of maybe a personal portfolio.
Yeah, so Love the Notre Dame, now where we talk about death, taxes, and lawyers.
He's a super
He's a barrel of
positive
monkeys,
panel
this guy,
member.
right?
So,
And you better do one of those things fast because the world's coming to an end as well, according to John.
So what is Love the Notre Dame? So Jack and Kathy Brennan and John and Beth Wiemeyer led this initiative the first time around, and we're having another go today. So Love the Notre Dame is about planned giving. And when you hear about Jack and Scott talk about really thinking about the university, not just in the present, but over the long term, one of the things that becomes clear is that it's increasingly difficult to feel comfortable about the university's finances when you really don't have a perspective beyond a typical capital campaign. And the capital campaign obviously has been an enormous success, and all of you are so generous. But as we think about the university for the next 50, 100, 200 years, it's hard to do that planning when we don't have a longer term source of giving. So planned giving, this will probably blow you away, but 1% of people who give to Notre Dame have named Notre Dame in their wills, which is pretty astounding, I think, relative to how generous people are with Notre Dame in their lives. And all of you in this room have made a statement about the importance of Notre Dame in your life, and we couldn't be more grateful for that. But I ask you all, as part of Love Thee Notre Dame, to begin to reflect on what kind of statement you want to make about Notre Dame after you to leave this earth. And that's really what Love Thee Notre Dame is about. It's not, hey, please put please put Notre Dame in your will tomorrow. It's really to begin the conversation. And for many of you, you probably haven't really begun the conversation in your own homes and as couples as to what you want to do, what is your legacy, what kind of statement do you want to make, not just for Notre Dame, but your other charitable interests. And I think Love Thee Notre Dame is a great forum to begin to do that, because you have people like TJ and Rich and Greg Dugard, who better to begin the discussion about wealth planning and planned giving than Notre Dame. And so that's what we're trying to do. There are all kinds of different vehicles, but I guess what I'd say is the headline is you've seen the track record and performance of the Notre Dame Endowment and the investment office, and not just the performance, but the fact that it's a mission-driven performance. So Scott and the team don't just invest in anything, they invest in things that are consistent with the mission of Notre Dame. And if you put money with Scott and the team, it's going to surpass any opportunity that you see elsewhere. And the best vehicle for that is this donor advised fund. I bet many of these people already have one. They probably have one with their banks. And why not have one with Notre Dame, where you can feel really good about the future earnings power of your wealth, and also do it with someone who has a mission in mind, and hopefully allows you to begin the conversation, as I say. And so Rich and TJ and Greg, I mean, these guys are all lawyers, they're tax experts, and who better to trust in this conversation than Notre Dame? And so you'll be hearing this a little bit as you go to your councils, and hopefully over the next couple of years, but really focused on it. As I have learned more, I'm really very committed. Jill and I are on the committee, and to really highlighting to people just not only the need for the university, but the opportunity for you as you think about your own planned giving.
Can I
Yes.
put that in a broader context? Back to your first question to me about the university. This is I think I'll say that. I'll out somebody. A guy came up to me after I gave a talk in Boston, and he said, "You were my intern in 1975." And so I'm quickly trying to read his name tag to see who he is. and I kind of vaguely recognized the name. I said, "What do you do now?" He says, "I'm the CFO at Harvard." I said, "Oh, that's interesting. How's that?" He goes, "It's great, but we're not as good as Notre Dame." So Notre Dame's the best run academic institution in the world, which was really great flattery from, it's Harvard's Harvard. It's a great institution. But one advantage that he has, even as well run as we are, that Harvard gets 30 or 40% of its cash flow every year from planned gifts, because Harvard's been doing this for 300 years. We get, I don't know, Lou, is it 10 or 15% less? Think about that. So we don't want to be Harvard, but we want to be as good as we can possibly be. And on John's original point, one of the ways that institutions that we compete with, who admire us and we admire them, they've been around a lot longer than we have. So they have this established way that their benefactors have made a statement in perpetuity. But competitively, got back to Father Hesburgh's comment, it really is important for us to be able to keep this as the best run academic institution in the world, but to plan in 20 and 30-year chunks like we want to do in terms of the academy, the physical plants, our student body. And so there's a competitive reason that this matters to us as an institution, and it's why we're also committed to it as a matter of course.
Yeah, no, it's a great initiative, and there's obviously cost advantages in terms of no fees and tax advantages, and especially with the CRTs and otherwise, it's terrific. I mean, the first question I asked when I joined the Notre Dame family was, can I get my retirement account with Scott? I can't, but you can do it through a planned gift. Well, why don't we open it up to the audience for questions? I could keep going, but if you can wait for the mic, just kind of put your hand up if you have a question, and that would be great. Okay, it's coming right here.
So, excellent panel. Thank you all.
Bill.
Very interesting comments. Scott, I've got a question for you, and it might relate to Jack a little bit, but there's some there's some theory out there on valuations of equities that as we get more and more and more index, that we're not sure whether the public markets are valuing securities like they used to. And I know you've looked at that, but would you give and then Jack can rebut or whatever, but would you? Thank you.
I can give the correct answer if he gives the wrong answer. Is that it, Bill?
Well, no, thanks, Bill. I mean, first of all, index funds are price takers, right? They don't set the price. They're taking the price of whatever companies are in the index. You can look at this a lot of different ways. I mean, these momentum funds, they're trading on price movement. I mean, there's a lot of things that make the market less efficient that are going on. They're not based on fundamentals. Indexing is not based on fundamentals. Its size is an advantage because of trading and cost. So neither of those two things are based on fundamentals. But then you overlay all the algorithmic trading going on and the systematic trading, which is now 70% of the market. So it probably has become more efficient because of all of that. But I still believe if you're investing in really good companies, just sort of the Warren Buffett philosophy, with strong moats, good brands, et cetera, good cash flow, over time that'll be recognized in the market. So I still believe that we can find a handful of great companies to invest with for the long term. But it is more complicated. Now don't forget, $4.5 trillion of quantitative easing will lift a lot of boats. Right. I mean, so passives had the advantage of that, right? Just that sort of lifted the whole market because of liquidity. That's over, or that's ending, at least, has ended. And there's been some tightening. So we'll see how this plays out. Luckily, we have a long time horizon, so we'll see how it plays out. We're not changing our strategy, though, because of that.
The more interesting part, in some ways, I agree with Scott, is John's world. How big is the pie of public equities? It's less than half what it was a decade ago. There's been a bunch of IPOs recently, but there is a whole world out there that was fringe 20 years ago and is now core. And people who have access to it have to make a decision. Am I willing to take some illiquidity to invest with a great firm like John's? And in the hopes of running the businesses the way you want to run the business rather than under the pressure of quarterly earnings. And it's a really interesting phenomenon that I think has snuck up on us and has an effect in certain parts of the market where there may be liquidity problems that distort valuations.
Yeah, just to add to that, in 2000, there were nearly 7,000 public companies, and today there are less than 4,000. And meanwhile, in private equity land, there were less than 2,000, and now there are over 7,000. So I think when you think about public equities, you either have to take the view, I'm going to just look for beta, which is invest in Vanguard products and not try to call individual equities or be in the conviction game like your son. But I think a lot of people fall in the middle, and that's where you really get hurt. And the only thing about the conviction game is conviction is a word we use a lot at our firm. You really got to believe, and you got to stick your neck out there, and it takes a lot of time, a lot of diligence before you can jump in. And that would be my advice, which is decide if you just like the market and play beta, go to Vanguard, or you really want conviction, then think of professional managers who are good at conviction. I think where Fidelity and Wellington fall down is they're sort of in the middle, because we got conviction, but we own 100 stocks. Well, that's not conviction. Right. And you also just have this god-awful everyday report card of the share prices go up or down, not exactly sure why if you're the CEO, and you go on the road, and half your investors want you to grow, the other half want you to cut costs. And
buy back stock. Oh yeah, no,
it's really hard to be a public company and invest in the long term, and then you see these unicorns, we can't wait for WeWork. Oops, WeWork CEO is gone now. Now we're going to have two CEOs. Isn't that great? Or even, Scott and El Caterton took a company public, Peloton, which I'm sure had their book covered 5 or 6 times. And then next thing you know, the share price down 10. Why? Because everybody's like, thank you very much. I'll take that. And then flip it. And so, Trump spent a little time on this. Somebody sooner or later is going to figure out how to make the public equity market, 1, more attractive, 2, more long-term, and 3, just more functional, both for investors and for companies. Because right now, I think it's a really hard road, which YPE has benefited.
More questions?
Thank you. I wanted to promote the Donor Advised Fund. I'm almost certain we had the very first one at Notre Dame written by Jean Gorman, if you all remember her.
Yeah.
And to me, the big selling point was the other half. The first half goes to Notre Dame. The second half, you're not sure where the hell you want it to go, but it's a very good way to stash it away. You have to sort of write your will and do all that, but you have it sitting out there.
We have lawyers outside. No,
Exactly.
this room.
We got to get this guy on the committee,
Yeah,
by the way.
Bob, could you speak up? I'm not sure everybody can hear you. No, I'm kidding.
You're doing a great job.
I've never had difficulty competing with you for speaking up. But anyway, it's a very good holding place. And, you know, and it even goes 10 years after your death if you haven't made up your mind, and someone good like your relatives can make up your mind for you at that time. So I just want to say a good word for that.
Thank you, Bob.
Thank you.
Thank you very much.
You know, just on that point, Bob, I actually, the legend at least is that you were the first one, and it is one of those things, it's a mistake people make, frankly. They have a small family foundation.
Yeah.
With all the costs that go with running that, when they could put it in Notre Dame DAF, get asset management for free from the best team in the world, and all the benefits that Bob said, and it's been fun. It's been one of the things of this lovely Notre Dame journey over the last 8 or 9 years is how the people who love this place have become aware of it, and it's something that really is compelling as a way of giving to the university that you love, but also being a better philanthropist because you're just smarter and lower cost, and if you're lower cost, you got a better, you got more money to give to charity. It's great.
Yeah, and to geek out for a moment, I'm looking at Rich. We will have next year a world-class portal too. So just like wherever you have your money today, you'll be able to go online and look at your money. Scott only has valuations every quarter, so it doesn't go up and
But
down.
you can call Scott anytime.
I was going to say,
if
there's
you'd
no
like.
phone number. You're not allowed to call Scott.
Yeah, we want to
Doing
do
the
that.
I have a special phone for the
Okay.
CRTs.
Okay.
You actually, at one point when Scott was becoming an 800 number rep with people calling, asking about their charitable remainder trust, we suggested that may not have been the highest best use of his time, so.
But anyway, you're not sacrificing anything in terms of, well, one, the performance is the best in the world, and I think we'll
But you have
follow up. We have those
transparency.
amazing slides that just show the power of investing. But two, in terms of your tax reporting, how you be able to get visibility on your positions and all that, it'll be world class, right, Rich? Definitely. He set a certain date. We'll add 6 months to it, but it will happen in 2020.
Do you have some more questions? Yes. Right over.
Thank you. This one's to John Coyle. For those folks that want to leave something for Notre Dame in their estate plan, but maybe aren't ready to get into a particular product like the Donor Advised Fund, could you address kind of the natural hesitancy that some folks have because they don't know where life's going to lead, and Notre Dame's flexibility to accommodate them?
Yeah. So, and thank you from a fellow committee member as well. So good question. But yeah, look, I think as I was saying a little bit earlier, I think the natural hesitancy is I'm not exactly sure what my financial position is going to look like at my death, and I'm still very much in the prime of my career. I believe my earnings power, but I don't know how it's all going to end. My children are a work in progress, so I think they're all going
I can vouch, they're
fine.
terrific.
Thanks, Dad.
But they seem to like living in the basement, so not sure how long that's going to go on. But it's not my children, generically. But so I think the question is, we all think we're going to live till 90, and why now? So, well, one, we don't know if we'll live to 90. Two is there is a lot of flexibility in that over time, as your financial position changes, the university is very flexible in terms of adjusting your commitment. A lot of people in the end give a certain number and then bring that forward because they realize, hey, why am I sitting on all this cash and I want to give it to the university sooner, or I want to give it in a different way. And I'll just go back to what I said earlier. For all of you, I just hope you begin the conversation, and again, no better place in terms of a place that you believe in and trust with Notre Dame, but there's
I mean, the
incredible
minimums
flexibility.
are very flexible.
Yeah, the fact that the donor advised fund, as Bob is saying, is half it's to Notre Dame, the other half can be to any of your own charitable organizations. And again, I bet many of you are already doing the DAF. Most of you, if you start thinking about planned giving, that's the first place you start is the donor advised fund. So, and you're not dealing with Goldman Sachs, JP Morgan, Vanguard. You're dealing with the same people that you love and respect and know in the end they're going to do the right thing, not just for your family, but for the university.
We have a question up there.
Amy's getting her steps.
This is addressed to Scott. How are you taking into context the tariffs, and what do you think? How's that going to affect the everything? I guess I want to say that just the markets, but how are you taking the tariffs into account, and where do you think the tariffs are going to end up?
Well, historically, protectionism has not been a very positive influence on global economic activity. So I'm very concerned about it. Having said that, I do believe that our trade relationship with China was very distorted, and they were stealing intellectual property. And when we admitted them to the WTO in 2001, they were supposed to comply with international rules and laws in that regard. And they haven't on a number of those factors. So I think President Trump taking them on in a number of these areas is the right thing to do. But what I don't want then is sort of a trade war and then a currency war and all of that. So we do need to keep in mind the bigger picture globally. Things are much more interconnected than they used to be. Markets, central banks. So you have to be mindful of that. That's just the reality we're living in. So we're monitoring it. Again, for me, it comes down to the quality of our partners. The kind of companies they're buying. These are companies that are going to do well regardless of that, for the most part. So the quality of assets we have is very good. But certainly, from sort of a macro picture, very much monitoring it and concerned. I'm hoping we'll get some sort of reasonable deal with China and other countries, and we'll get back to business. But it's definitely disconcerting.
Do we have other questions? Pretty good on a Friday. Jack, can I ask you? But I want to thank.
Before we do, Rich and TJ, sorry to
Yes,
embarrass
why
you,
don't
but
you
just
guys
please stand
up.
These two guys are amazing.
Introduce yourself.
And,
Yes. Good.
We're really lucky to have them, and they're both fantastic, and hopefully you'll take advantage of the opportunity to speak with them as well.
Well, I want to thank everyone for coming, but before we close out and thank our panelists, of course, Jack, I just want to turn it over to you maybe for the last word here.
Sure, thank you. Listen, events like this are fantastic and so enjoyable, partly to be with, Erin's less than a year in, or just about a year in, and she's a great Notre Dame woman. She's fabulous. And Scott and John, exemplify the type of people who love this place and commit time, energy, talent to it. And, it's always inspirational for me, I have to say that, but the same thing is true looking at the audience. We started out talking about the fact that this is a place that has lots of ambitions, lots of accomplishment in its past, but ambitions to be the best, but over centuries, not weeks or even years in that sense. And your benefaction to us, for which we're continually grateful, and I can assure never take for granted, in whatever form it takes, is something that, on behalf of the university, I want to make sure to say thank you. But I hope this afternoon we've had a chance to just give you a little perspective on a whole bunch of things, whether it's markets or the university financial position or things that could be really great for you and your family as well. So, Erin, I want to thank you, and guys, thank you for organizing this, because I, for one, learned a lot just listening to the people here. But as I said, there's nothing like starting a football victory weekend with an inspirational group of people like you. So thanks for letting me have the last word. And as they say, go Irish.
Go Irish.
Thank you all very much. Thank you.
Well done. Very well.